Welcome to The Prescription, the Urban-Brookings Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with government officials, leading economists, and other tax policy experts. I'm today's host, Thornton Matheson, Senior Fellow at TPC, where I specialize in business and environmental taxation. My guest today is Adam Cohen, Google's London-based Director of Economic Policy. Prior to joining Google in 2010, Adam was an economics correspondent from Dow Jones and the Wall Street Journal. He holds a BA from Harvard and a master's from the London School of Economics. We'll be talking about current issues in the taxation of digital services, including the OECD's base erosion and profit shifting, or BEPS initiatives, national and regional digital service taxes, or DSTs, and the evolving US corporate income tax. Adam Cohen, welcome to The Prescription.
Thanks for having me on, Thornton.
So to start off, can you give us a brief overview of what you do for Google as it pertains to tax policy?
Sure. I'm on what we call our government affairs and public policy team, and I deal with a wide range of regulatory and political issues. And I got involved in tax policy about 2010 or 2011 or so, when more and more governments, more and more politicians were asking questions about how Google and other technology companies pay taxes, with a large focus on corporate income taxation. Most of this discussion was centered in Europe, where I've been based for quite a long time. And from there, we were off to the races with a discussion at the OECD around base erosion and profit shifting, and subsequent developments in EU and US tax policy.
Great. So let's start off talking about OECD BEPS, which, as we previously discussed, got started in large part because of issues surrounding the taxation of large US tech companies. What are your major concerns with respect to what's now called BEPS 2.0, which is basically Pillars 1 and Pillars 2? And how would you like to see those issues resolved?
Well, I think the BEPS work and the general work of the OECD is actually quite a lot broader than this. I mean, if you look at the BEPS project, which started back in 2012, Chapter 1 was a focus on taxation of the digital economy, but there were 14 other chapters that focused on a whole other range of issues in the way that multinational companies are taxed, concerns about profit shifting, concerns about the use of tax havens or tax shelters. And the BEPS project, which was a 2-year study and led to subsequent policy changes, I think was very, very broad, and led to some very fundamental changes, I'd say. I think in the current discussion, what you described as BEPS 2.0, I think it's much narrower, and it's focused on two things. One pillar is thinking about ways to reallocate or reapportion taxing rights for some of the largest, most profitable companies in the world, not just digital companies, reallocating those taxing rights to the countries where products and services are consumed rather than where they're produced. The second pillar of this discussion, as it's called, is around minimum taxation and implementing a global minimum tax. The current discussion is around 15%. And this idea, which is quite different, is really, I think, designed by some governments to address concerns that they're facing tax competition from low tax jurisdictions. So those are, I'd say, the two salient issues. They aren't necessarily digital only issues. They are potentially the areas from the initial wider BEPS project that seem unresolved or unfinished, but the work is ongoing there.
So let's talk first about Pillar 1, the destination-based tax, which is another way of describing what you were talking about, taxing companies on the basis of where their products are sold or consumed. It's a destination-based tax on only certain very large and very profitable corporations. Initially, that will be corporations with global profits, global revenues of at least 20 billion and a profit margin, profits to total revenues of more than 10%. And then pillar one would take 20 to 30% of those excess profits and allocate them, as you were saying, on the basis of where the products are sold or consumed. What are your, do you have any significant concerns about this design? Are you basically fine with it? How would you like to see it refined or reshaped?
Well, there are a lot of details still to be worked out. I think that you outlined the broad strokes of what we're hearing from the discussions. I think that there are lots of choices and alternatives even embedded within that description that are still to be made. And at a very high level, I'd say the main objective here, it's not a concern at this stage, the main objective here is to get to some international agreement so that the way that this pillar is implemented in country Y is agreed upon in country Z, and that there is no room for dispute or disagreement about how that reallocation of taxing rights should work. The key thing from our perspective here is reestablishing certainty for taxpayers internationally, so that based on your activity, based on your investments, based on how you deal with customers in a particular country, what your tax obligations are going to be. I think there is sometimes a hyperbolic focus on tax rates and whether this rate's too high or that rate's too low. I think that for the most part, what companies really want is tax certainty. That's certainly been our position in this, and that this work is very valuable if it can reestablish tax certainty.
Right. And in that context, one of the things that Pillar One is being designed to do is to replace some of these digital service taxes that companies, including the UK, France, Italy, and also India, have implemented. And these tend to be fairly low rate taxes, 2 to 5%, but on gross revenues from certain digital services, such as advertising services or provision of a digital platform. Because the global economy is changing with the growth of digital services, from a corporate tax perspective, it's become more and more difficult for some countries, especially developing countries, but also European countries, to tax corporate activity in the digital realm, because, as you know, traditionally, the corporate tax has been based on productive activities as expressed in tangible assets and payroll. So it's very much of a bricks and mortar tax, whereas profits are increasingly generated by digital activities. So these digital service taxes that countries have been introducing are an attempt to grab this kind of elusive digital tax base. I wanted to ask, what has been your experience, Google's experience of these digital service taxes to date? How have they affected you?
Sure. Well, I mean, we're paying them where they have been implemented and where they apply. You named some of the countries. I think one of the important things to know about the OECD's work on this and the BEPS study between 2013 and 15 is that they reached a conclusion that the digital economy wasn't different from the wider economy, that the whole economy was in fact digital or digitalizing, and that there wasn't a sort of separate strain of commerce or activity that was totally different or divorced from the way that other businesses were operating. I think that there wasn't a firm conclusion. Some people said there was clear evidence of base erosion from countries, as you just described. Some said the opposite, that tax bases were actually increasing in countries due to digitalization. I think the picture was quite mixed there. As you note, the global system of taxation for the last century has really rested on this notion of physical presence. And there are concerns about whether or not that is fit for purpose in a digital age. But to match with the OECD's factual findings of this, if the wider economy is not just 3 or 4 companies, the wider economy is digital or digitalizing. Lots of companies are attributing profits to their IP, the development of their technologies and innovative products. how should the tax system work? And I think that what you're looking at with the current discussions around Pillar 1 in particular is an update to those rules so that the destination countries where those products and services are consumed are receiving some type of remuneration for the activities that are happening there, even if there is a limited physical presence.
Right, right. Yeah, you mentioned IP being the source of many of those digital profits. But of course, IP, similar to digital activity or closely linked with it, that's an issue too for corporate taxation because IP is so mobile. Again, unlike labor force or plant and equipment. IP can be shifted not freely, but more flexibly across jurisdictional boundaries. And we'll come back to that later on when we talk about Google's IP sourcing. But I wanted to ask you, so the US has linked Pillar 1 to the repeal of unilateral digital service taxes. And in fact, we've threatened trade sanctions on countries. I believe they're suspended at the moment pending these Pillar 1 negotiations. We've threatened trade sanctions against countries that do not, where there's been a finding that the DSTs are discriminatory against US companies if they don't repeal these taxes once Pillar 1 is put into place. Do you expect that to happen? If Pillar 1 were adopted, do you expect that countries would, in fact, repeal their DSTs?
I'm not so close to these negotiations that I could have that insight, but my understanding is that countries that have been working with the United States have approached this Pillar 1 discussion with the idea that digital services taxes, as you described, are a temporary or an interim measure, and that a better, more robust system should replace it. So, most of that I've read from the press, so I take that at some degree of face value.
So let's move on to discuss Pillar 2 briefly. This is, as you mentioned, the global minimum tax, and the current blueprint as of last month calls for at least 15% minimum rate global minimum tax. And this would mean for each country, the current practice worldwide, outside of the US, that is, most countries exempt the foreign earnings of their domestically headquartered multinational corporations. They tax them on their domestic activities, but their foreign earnings are not subject to tax by the home country. The US is, of course, the major exception to this rule with its GILTI regime. And that's global low income tax, global intangible low tax income for our audience. We do tax our multinationals on their foreign earnings at a rate between 10.5% to 13%. But they're allowed to pool all of their profits and losses across all foreign countries. The Pillar 2, by contrast, would have a slightly higher rate, at least 15%, but foreign earnings would be taxed on what's called a country by country basis. So you can't pool across jurisdictions. And there would be what the OECD calls a carve out, which would be about a 5% of the carrying value of tangible assets and payroll. Now, the US also has, GILTI also has a carve out, but it's slightly different. It's 10% of foreign tangible assets. So there are some slight differences in the tax, but the current practice for most countries, which OECD Pillar 2 would change, is to fully exempt foreign earnings. The point of my rattling through all of this is I wanted to ask, Google, of course, is a US multinational, so you are currently subject to GILTI, is that right?
That's correct.
Right. So
has had global taxation for multinationals and U.S. citizens, I should add, for a very long time. I mean, quite uniquely in the world. Even before the GILTI was implemented in 2017, the overseas profits for U.S. multinationals were still subject to U.S. income tax.
Right. And back then we had a much higher rate, 35% as opposed to 21% currently. But the major difference was, of course, back then you had what's called deferral, which means the foreign earnings of multinationals were not subject to US taxation until they were repatriated as dividends to the parent country. And actually, worldwide taxation used to be pretty common among OECD countries, but over the years, even as corporate tax rates have come down, we've also seen more and more countries switching from worldwide taxation, where they tax those foreign earnings, to what's called territorial taxation, where they exempted them. Right before TCJA, the 2017 U.S. corporate tax reform, TCJA, the Tax Cuts and Jobs Act, right before that, we were really sticking out like a sore thumb, 35% rate and worldwide taxation. But companies could use deferral to avoid that taxation, and they did. They had this huge stockpile of unrepatriated foreign earnings, and so GILTI got rid of that, because now that with GILTI you're taxed at a much lower rate on a smaller slice of your foreign earnings, but you're taxed immediately. So there's no deferral. So in some ways it's better. In some ways it's not worse, but in some ways it's looser. In some ways it's tighter. But what a lot of U.S. multinationals have argued is that because they are subject to a worldwide tax, whereas most other multinationals in the world are subject to territorial regimes, that this affects competitiveness. And they feel that it's an uneven playing field. Is that Google's experience?
I think these are difficult questions, because these policies, a lot of them were in place before Google was founded, and to some degree, some of what we saw prior to 2017 were tensions between a unique and quite, let's say, a U.S. tax system that was an outlier in the international economy relative to other countries, and a lot of questions, I think, that sparked this discussion about whether or not U.S. multinationals were paying the right amount of tax or sufficient amount of tax in European countries, actually touched on this question about deferral and the overseas income that was kept offshore by many different U.S. multinationals, not just tech companies. I think those, for lack of a better description, that cash pile became a target, and countries started looking at it thinking, well, what are the policies we need to implement to claim some of those untaxed profits? As you rightly point out, they were taxable profits with they enjoyed deferred taxation, but they certainly weren't tax exempt. I think that where we're headed and where we've been going in this discussion through the 2017 Tax Cuts and Jobs Act, through the BEPS process, through the current discussions around minimum tax that you've highlighted, is a bit more conformity in the international tax system, a bit more symmetry between the way that the US tax rules work for US multinationals and the way other countries operate as well. And I think that that's necessary. I don't, if one country's rate is 1% higher or lower than another, is it going to affect investment decisions or all these other economic factors? That's very hard to say. But I think what you need for a well-functioning global tax system is some degree of symmetry and mutual understanding about how these rules work. When one system, like the US system is so divergent, I think it leads to it has led to a lot of problems.
Well, so as we've discussed, there are some significant differences between the GILTI regime and the proposed Pillar 2 regime. And although GILTI is different, there's also a proposal within Pillar 2 to create an exception for the US regime to allow GILTI, such as it is, to continue. If most foreign countries or major capital exporters were to adopt Pillar 2, such as it's currently mapped out, do you think that would level the playing field, or would that give US firms then an advantage?
it really depends on how the rules are implemented. One of the things that's come out of this discussion is that you see several countries saying very firmly that they will still be able to incentivize various activities like R&D through tax incentives, tax credits. I think more important than looking at a sort of headline minimum tax rate are really going to be the effective tax rates in the long run for multinationals in the US and other major economies. And I think the goal, I think most countries agree with this idea that you want to be comparable. You don't necessarily, I think that the major economies are very worried at the moment about tax competition. And I think that one of the discussions around the OECD is how do we make not these systems exactly mirror each other, but make them more compatible and let's say more similar to each other.
I want to turn briefly to recent changes and also proposed changes in the US corporate income tax. We've talked about some of the changes introduced by TCJA beginning in 2018, the rate cut to 21%, the GILTI regime. But there was also, and I think importantly for Google, the so-called foreign-derived intangible income, or FDII regime, which gives a substantial deduction for certain domestic excess profits that relate to export sales. And if I understand correctly, Google did a major reorganization in 2019 and is now, whereas you used to source your IP offshore, or a good portion of it,
partly.
You now source at least the majority of it onshore. Can you talk about the motivations for that reorganization and how they relate to changes in TCJA?
Sure. So it starts a lot well before the Tax Cuts and Jobs Act in 2017. The US tax system had basically encouraged all US multinational companies, not just tech companies, to offshore a portion of their IP so that you could have these foreign earnings that enjoyed tax deferral. And that was seen as necessary. And frankly, the legislation, I'd say, if not encouraged it, certainly facilitated it. It was seen as necessary to address the fact that the US federal and state tax rate was around 40%, and headline corporate tax rates across the other OECD countries were trending down into the low 20s. So Google, like many other companies, had international IP. Due to the BEPS work at the OECD and subsequent changes in Irish tax law and in the US with the Tax Cuts and Jobs Act, we repatriated our IP at the end of 2019, so it fully resides in the United States. Part of that was due to what you described, the FDII or FDII, which was designed to, and again, not just for technology companies, was designed to encourage companies to repatriate their IP, invest in the United States, create jobs that that advanced and exploited that IP in the United States. It was seen as a way to incentivize the right behaviors.
I see. So it was not just the U.S. changes, but also changes in what was happening abroad, right? Yeah, and sorry?
Global changes that were being implemented, I would describe it as.
Right, right. Yeah, so as I'm sure you're aware, the current administration has proposed several significant changes to U.S. corporate tax policy, increasing the tax rate to 28%, and very much tightening the GILTI regime, going to a country-by-country basis and eliminating that carve-out for 10% of foreign tangible assets. And also abolishing the FDII regime. How concerned are you about these tax changes, and if they were enacted, I mean, how would that affect Google?
Well, like any U.S. company would be subject to these rules. I think that the key thing from from my perspective. It's hard to evaluate these sort of policy proposals in a vacuum, because you don't always know. I mean, being in a company, you don't always know what the trade-offs are, right? Certainly, we understand the need for governments to raise revenue. We certainly support the ideas of this administration to invest in U.S. infrastructure, and we think that's going to increase the U.S. economy's long-term capacity and capabilities. The question is, how do you do it? How do you raise that money in a way that doesn't disincentivize R&D or doesn't re-incentivize U.S. companies to offshore their IP? Like, how do you design the policies in a way that works best? And there are always trade-offs in those discussions, and I'm not particularly privy to all of them. I think from my perspective, particularly as somebody who works for an American company internationally and having been exposed to so much of the international debate about corporate tax reform, I think it's important that the U.S. Tax system sit compatibly with the way that other countries work. That means in terms of very granular policies and how they're affected. It also, in terms of competitive rates, competitive effective tax rates. I think all of those things are important factors. They're not the only ones, but they're important factors that should be taken into account.
Okay, well, and just to wrap up then, what are your most important goals? I mean, I take it part of your job is influencing policymakers to enact particularly corporate tax, but also digital tax and other taxes. So what are your most important goals in terms of either U.S. or foreign tax policy at this point?
Maybe it sounds highfalutin, but I would say a sound and stable policy environment would be our goal here. One where, as easily in a conversation with the UK, France, other countries, or with the United States government, with either elected officials or tax authorities, everyone involved in the discussion enjoys a much higher degree of clarity about how the rules should work, what the outcome should be. I think that's really key for the next phase of international business in terms of unlocking more potential, more cross-border trade and investment. And these goals are obtainable. I think that there's been a long and complicated process over the past 10 years, but I'm pleased to see how countries are working together, because they do understand the importance of getting this right.
Right. And you also mentioned the U.S. infrastructure, which is, of course, currently being negotiated. From Google's perspective, what are the most important infrastructure elements that you see as necessary to continue growth and productivity in the U.S. economy?
I'm a little too far from living in London. I'm a little too far from the U.S. infrastructure debate to tell you. I mean, again, a series of questions about trade-offs. What's more important, having modernized, safe bridges or faster broadband? I mean, I'd say that they're both important, and all of these things have to be developed and work fluidly together. I don't think we can have one and not the other.
Right. But the overall tax burden in the U.S., that's a trade-off with public investment.
There's a lot of debate about this. I think that people will say that increasing the long-term capacity of the economy will increase your tax base. I think there are others that say, look, front-loading all of this is going to squelch some investment and some economic activity. Those are big, important questions, and getting the balance right, that seems like one of the most important jobs for government today.
Okay. Well, Adam Cohen, Director of Economic Policy for Google, thank you so much for coming on this prescription.
Thanks for having me.